you go to 2030, what do you see the size of the industry?
Just staying in this journey of this country will benefit everybody in the right way. And once that change happens from a risk seeker to a risk owner, starts this brilliant curve of owning financial assets. And the romance is in the wait, right?
Yeah. Hello everyone. Welcome to another episode of the Wealth Insight podcast, where we take our conversation further with Swarup Mohanty, Vice Chairman and CEO of Mirae Asset Investment Managers, India. Thank you, Swarup, for joining back.
No, thank you so much for continuing this one.
So, Swarup, we left at the episode talking about the mutual fund industry. And one point which you spoke about was on the hybrid funds. Now, a lot of people say this could be just a trend chasing. But do you see investors actually taking now asset allocation calls? And this is where hybrid funds fits very well in a client's portfolio?
See, actually, the hybrid started from one asset class to two asset classes. Now it's three asset classes with the inclusion of commodities. And it will progress to four asset classes with the form of, in the addition of REITs. So then it becomes truly diversified across asset class and can be called hybrid in its true sense. And now there is a very important place for that product in everybody's portfolio, according to me. Finally, if you do a backtesting or any sort of analysis, the probability, which I said also in the last episode, is that the probability of getting median returns is higher in a multi-asset structure than a single asset structure. And the risk mitigation also happens. By virtue of that, I mean, in say Europe, 80% of investors invest through a multi-asset structure. Whether you go through a multi-asset structure or you form your asset allocation accordingly is up to you. But that will form the next level of investing, is my firm belief.
Swarup, one more trend which we have seen, and globally it's been very prevalent, but recently in India is the entire growth of passive funds. And Mirae Asset actually globally does more passive. India is one of the more active markets. What do you think is that growth trajectory? Do you think it will be faster than how active fund managers are developing? And can we adopt some of the best practices which Mirae has done on the passive sides to the India market?
Actually, incidentally, India is the only active book of Mirae Asset globally.
Yes.
And globally, market has moved there.
Yeah.
As transparency increases and price discovery sort of minimizes, the investing moves to more index in nature. Now, that's not so in India. And especially in the last 2-3 years, which you've seen a spate of public issuance in the market, the scope to select stocks for fund managers has only grown. And the beauty of these public issues in the last 2-3 years has been such a lot of new, I won't say industry, but lot of new segments have started coming into the market. Hospitals, asset managers, capital market index being enhanced dramatically, textiles, I can go on. So the choice, and incidentally, most of them are listed in the mid and small cap space. So the choice of the fund manager remains alive, hence active remains alive in India. But in India, from a mutual fund perspective, categorization of funds is there. So there is that much ideation that can happen on the active side. While on the passive side, wherever there is an investable universe, one can create an index, and on that index can, through factors, give multiple forms of that index. Simple point I'm making is ideation is unlimited on the passive side. So what you will see is the generation of very interesting ideas coming from the passive side. That's not relevant only to India, that's relevant to the world. Now what's happened in India is, since we started a little late, we did not go through the rigmarole that the West has gone through. We can start picking and choosing what is applicable to us. We can go straight from, say, starting with a market cap index to factor investing, depending on what is good for us. We can choose, right? And that's our beauty. So that is why over the last 4-5 years, we've seen some incredible growth in passive investing in India. But the stage as it is, and correct me if I'm wrong, bulk of investing in India still happens in market cap.
Yes.
Large, mid and small.
Yes.
What will happen going forward is ideation taking to the front. I mean, say a simple thing like you want to do defense. Is there a defense specific idea possible? You can do it through an index. Now, I might want to zero in further into energy. I can do that on my own. Suppose at this moment, because of the broad basing of the market, I feel Nifty 500 is a more
Better index.
better represented index than Nifty 50.
Yeah.
Now, within Nifty 500, you will say, boss, it's a long tail. Why don't you give me a shorter? So, I can give you Nifty 50, say value 30. I'll pick up a proposition in front of you and say, I will pick the 30 best value propositions, or I can say 30 momentum out of those 500. So, that's the beauty of passives, right? And I think we're beginning to see the trend on that. If you mix the both, the portfolio can become stronger. There'll be a lot of complementing ideas on the passive side, which you will not get on the active side. Typical example, I'm not selling my product, but it's just that there is no category called mid and small.
Yeah.
While we have an index called mid and small.
Yes.
You cannot deny the importance of that portfolio. So by adding such complementary products to a great active manager, you get a better portfolio.
Actually, there's two-part question because you talked of mid and small. I wanted to go there, but also you talked about factor. How much of the smart beta and factor investing is it easier to understand for a mutual fund investor, or it's more of an institutional place where institutions can do this better?
No, I think it will become easier for the retail investors because factor investing brings passive investing closer to active investing by forming certain rules.
Yeah.
Right? Now, fact is, if I've said that a rule is, say, momentum,
Yeah.
that momentum factor has to be tested across market cycles
Yeah.
for the impact to actually come on the investor. Now, as we speak, we've probably gone one or two cycles through, and once it starts building track record, I'm just talking about one factor, all factors, once they start building momentum and track record over cycles, it will appeal very, very significantly to investors. I see them taking to factors quicker than say pure market cap indices, because there's a lot of power in rule-based investing. And on that day, on say the rebalance day, on an active fund management, it is left to the subjectivity of the fund manager. The rule will not have anything subjective, it will act. And it will act at all points of time. When you add up those data points over a lot of certain occurrences, you cannot take away the power of that. So let the cycles roll through. Let these factors show some track record of withholding or withstanding some very treacherous markets, and then it will dawn very quickly.
And coming to mid and small, right? If we look at the flows data, that has dominated over the last couple of years, and maybe the experience has not been great in the last 1.5 years, where especially with small cap indices not doing. Do you think this also is a sort of a trend chaser? And do you think clients should have that mid-small exposure, especially to active fund managers?
See, here's my thing. If you go back to 2016, again, I'm just giving an example. We closed our mid-cap fund in 2016 for lump sum citing not enough stocks in the market.
Yeah.
Right? Today, because of the public issuances, the range of type of companies and the companies which have come to the market have been more on the mid and small cap side than on the large cap side. Some incredible businesses have unfolded.
So a lot of the new age disruptive
Why only
companies,
new age? Look at it. An asset manager across board is a mid cap.
Yes.
Right?
Yeah.
Hospitals are all mid and small. Textiles are all mid and small. Chemicals are all mid and small. Right? I can go on. Now, to be an investor, you have to be an optimist. That's the fundamental rule, right?
Especially equity investor.
Yeah, any investor. Otherwise, you are in cash, right? Even cash gets depleted at the inflation rate. But when you look at the growth prospects of all this, and please understand, this country's growth will be very differentiated in its journey from per capita 2,500 to just 3,500. In that 1,000 change in per capita, a lot will change in the consumption patterns of the Indian. Right? Like in 2000, a friend of mine had said, a doctor friend of mine had said, with the penetration of medical insurance, hospital benefits will change. We are seeing that happening. So, a lot of correlation of all this will fall into place for the environment to change. And that is why I said Nifty 50 is no longer the true representation of the Indian market. It's with a lot of happiness that I say that Nifty 500 is a representation. Just shows that the breadth of the market has increased. Now the erstwhile cliched advice, and I'm going into your shoes, sorry for doing this, that the core of the portfolio is large cap and that should be 60-70%, say, is completely diminished, because just to catch the length of the market, you have to allocate more to mid and small now, just to catch these fantastic stories. You can do them on your own, but I feel a little more research is required at the smaller end, so you should come to a fund manager would be my advice. And then once those balance sheets take a different shape or rise the curve on their sizes, then probably one can analyze them themselves. But a good small cap manager has a lot to offer today than he or she had to offer just before COVID. So there's a lot of merit in this change, and it's been an unlearning for me personally. I thought the risk reward in India would always be in favor of large and mid. So my portfolio till recently, because my portfolio is at 12%, 11% was always on mid and small. But I also want to own these companies. So it's a fantastic thing that's happening at a stock market level.
Swarup, I've spoken of the mutual fund industry, but we have an entire alternate segment there. So how do you see the PMS and AIF? How does that complement the industry? And what's your take on this entire new asset class, SIS, which have come?
Yeah. Every product has its own merit. My only thing is that they should be differentiated from each other.
Yes.
If you're going from a mutual fund to a PMS and getting the same portfolio, then mutual fund remains a more tax efficient and transparent industry than them, right? Now, some very differentiated AIFs are there in the market. Whenever you invest, you should look at diversification. That is fundamental. So, if you're getting that on PMS and AIF, one should, right?
Like private assets.
Why not? Why not? Today, the worth of private assets is large in India. We run a good outfit ourselves. As we speak, the newspapers are talking about around 6,000 crores being raised in between South Korea and India for an India dedicated private fund. So the scope and the environment and the ecosystem is become quite conversant there. Why not own some of them? A lot of value happens before the company comes to the public market, right? So if one can catch that, nothing like it. But Vinay, what has happened is the regulator has chosen the mutual fund platform to launch this incredible concept called SIF, and we are waiting as an industry to express ourselves totally through that product. Please understand there is no categorization or limitation for the fund management unit to be bucketed into expressing our stock picking ability in any form. So what will happen is every fund house will express themselves differently. So first rule would be not to paint all SIFs with one brush. You need to go a little deeper and understand the fund management positioning and the way they want to express themselves through the portfolio. Second most important thing is, though we might say we need to now demonstrate our ability to handle derivatives over a period of time, and that's something which we are up to it, but we have to demonstrate it. So I'll leave behind one caveat to all your investors. Please don't look at this because it has a 10 lakh threshold. Look at it from the product merit itself. The merit is there. The risk profile is a little different. But we are very excited because we'll get to express ourselves the way we want in the form of our portfolio. We're just about to launch our first product. We can't wait to start it. But I think in the next 4 or 5 years, what you will see on the SIF side is practically the entire industry coming into it. And I'm very happy with the way we approached it so far. We are creating our backend and then coming with the product. We're not jumping into it from the day this has been announced, and that's the right way to do it. It is a fiduciary responsibility, and then the industry seems to have been approaching it with a maturity which I have not seen in the past.
So Swarup, in the first episode, we looked at your interest in vinyl records and we had a very nice conversation around that. In this episode, what we wanted to do is put you on the spotlight a bit and wanted to do a rapid fire. So Swarup, you're ready?
Yeah, let's see.
Bull markets make investors, bear markets make portfolios. Agree or disagree?
Agree.
One asset class Indian investors consistently underestimate.
Debt.
Is India a buy and hold market or a rebalancing market?
Merits of both, but I would buy and hold. Rebalancing, I would not take money off an asset class, I would add in the other asset class.
One quality that separates great fund managers from good ones.
Discipline.
One financial principle you live by that you would never compromise on.
Stay invested.
The one piece of advice you would give a first-time equity investor that nobody gives.
Ask yourself why you want to invest.
Very nice. One thing about India wealth landscape that excites you and one thing that worries you.
I think the youth of the country excites me. They will change the entire landscape. I don't think anything worries me right.
Swarup, thank you a lot. And I'll end with your tagline. There is risk to investing. There is risk not to investing.
Correct.
There is risk to investing in equity markets. There is risk not to investing in equity markets. At the current juncture, where are we?
I think that is now in bold italics and underline. Because see, in every adversity, there are opportunities. Volatility gives you opportunities. If it were one straight line, then the markets would go just one way, right? Because there is so much happening in the world, that some good businesses are available at some good prices. They were not available at these prices just 6 months ago, right? And that's what makes this statement even bolder. I mean, the risk to not investing is actually far larger than investing. The more you sit outside the market, see whether you agree, disagree, whatever, this 3.5, 4 trillion economy is going to become 7, 8 trillion.
Yeah.
Right? Somebody might put a date, it can be 1 or 2 years later than that. But the path is that. The sooner you get into the path, you start this brilliant process of getting that growth into your life. Right? The more you stay out of it, the more you miss the opportunity. If somebody would know when this market would reverse, that person would not be a salaried individual at all, right? Yeah. So the opportunity is between today and when these things settle, right? And when those things settle, trust me, the big monies can change the market in a jiffy. As an investor who does not know that day, the controllable is to accumulate it. The fact is, especially from an India perspective, you talk to any fund manager and you interview so many of them. The common line would be, I would like to buy a good asset at a good price. Yes. That India is a good asset is a foregone conclusion. The price is getting better.
Yes.
Right? So, this is the time. The risk to not invest is larger at this moment.
Thank you, Swarup, for sharing the entire your journey, how you built your asset management company and how we have evolved as a mutual fund industry and what to look around. I'm sure our clients and investors would be enriched by these conversations.
No, thank you so much for having me. Always such a pleasure doing this with you.
Thank you, Swarup. Hope you enjoyed this episode with Swarup Mohanty. Stay tuned for more of the Wealth Insight podcast, where wealth conversations come to life.